Short-term finance refers to sources of funding that are generally repayable within 1 year and are used to support the day-to-day operational needs of a business. Organizations require short-term finance to manage working capital, finance inventories, bridge temporary cash shortages, and support ongoing business activities. Effective management of short-term financing helps maintain liquidity and ensures that obligations can be met as they fall due. Among the most common sources of short-term finance are trade payables and bank overdrafts. Both provide businesses with access to funding without requiring long-term commitments, although they differ significantly in their structure, cost, flexibility, and risk characteristics. Trade payables, often referred to as trade credit, arise when suppliers allow a business to purchase goods or services and pay for them at a later date. Rather than requiring immediate cash payment, suppliers grant a credit period that may range from several days to several months. Trade payables therefore represent a spontaneous source of finance because they arise naturally from normal business operations. This form of financing is particularly important for managing working capital, as it allows businesses to obtain inventory and generate sales revenue before payment to suppliers becomes due. As a result, trade credit is widely used across many industries. One of the major advantages of trade payables is that they are often relatively easy to obtain and may not involve explicit financing costs if payment is made within the agreed credit period. They also provide flexibility because the amount of available finance generally increases as business activity expands. However, excessive reliance on trade payables can damage supplier relationships and may result in penalties, loss of credit privileges, or disruption to supply chains if payments are delayed beyond agreed terms. Effective management of trade payables therefore requires balancing liquidity needs with maintaining strong relationships with suppliers and business partners. A bank overdraft is another important source of short-term finance. An overdraft facility allows a business to withdraw more money from its bank account than the available balance, up to an agreed limit established by the bank. This arrangement provides immediate access to funds when temporary cash shortages occur. Unlike trade payables, which arise automatically through supplier relationships, overdrafts require prior approval from a financial institution. Interest is generally charged only on the amount overdrawn and for the period during which the funds are utilized, making overdrafts a flexible financing solution. The primary advantage of an overdraft is its flexibility. Businesses can draw funds when needed and repay them when cash becomes available, making overdrafts particularly suitable for managing seasonal fluctuations and short-term working capital requirements. However, overdrafts may carry higher interest rates than some other forms of financing and can be withdrawn or reviewed by the bank at relatively short notice. In addition, banks may require security, financial information, or compliance with specific conditions before granting an overdraft facility. Consequently, overdrafts provide flexibility but may also introduce uncertainty and financing risk. In summary, trade payables and overdrafts are two widely used sources of short-term finance that help businesses manage working capital and liquidity. Trade payables arise through supplier credit arrangements and provide financing linked directly to operating activities, often without explicit interest costs. Overdrafts are bank-provided facilities that offer immediate and flexible access to cash when required, although interest charges and banking conditions generally apply. While both sources support short-term financing needs, trade payables depend primarily on supplier relationships, whereas overdrafts rely on banking arrangements. Understanding their characteristics enables management accountants to select appropriate financing solutions and maintain effective cash flow management.